Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your daily technical analysis of foreign exchange markets. I'll start with the euro against the dollar. A contrary bearish black crow yesterday with a long head that stretched up to the upper trend line, currently at 118.12, of the descending wedge pattern. Meanwhile, the low was once again supported by the powerful and significant 50% Fibonacci line of the June 2020 to January 2021 move at 117.58. All this came after the previous session's interesting combined key reversal up, if only just, and bullish harami as well. So it seems what happened yesterday was an attempt higher as a follow-on to the key reversal up and bullish harami, but this was capped by the upper trend line. And on testing lower, the market found the strong floor from the 50% Fibonacci line still there. Effectively a bracketed market. Well, we all know that's not going to last. Overall, we still haven't gotten rid of the declining market, at least not yet. We continue to slide down just above the middle time, currently at 116.99 of the January to May bearish Andrews pitchfork. Now this pitchfork has taken on the mantle of being the bearish angle of attack right now. The other feature I've continually highlighted is the mid-June to date descending wedge pattern. This continues to also pace the market lower between the previously mentioned upper trend line and downtrend, currently at 118.20. And the lower trend line is almost parallel with the middle time, currently at 117.19. Now, wedge patterns can break in either direction, but they have something like a 70% chance of breaking higher, so bear that in mind. Can't give any targets as yet, but I can give an idea of the size of the move when it happens. An upwards break would be about 135 ticks on top of the broken downtrend, whilst the downwards break would be about 65 ticks off of the broken lower downtrend. Lower trend line, in fact. The descending wedge terminates in early September, but I imagine we'll have a break before then. One final point, beware of false breaks, beware of false breaks. With this wedge and wedges generally, they are really quite common, so treat all attempted moves with caution. So far today, nothing. A small indecisive doji cross, sitting a little way above the 50% Fibonacci line at 117.58 right now. Cable, aka sterling against the US dollar. A second bullish white soldier yesterday as the market re-established itself over the rising long moving average, currently at 137.20. The top was capped, interestingly, by the declining short moving average, currently 137.89, and not by the June to date downtrend. That's currently at 138.31, which is a seemingly far stronger rolling resistance. This continues to halt, if not completely eliminate, the idea of the move down since the start of June being a possible bearish measured move lower, with a potential target X in the 134.25 area. It also halts the further larger idea I'd put forward last month of a possible very large Adam and Eve type double top formed over the whole of this year. However, the latter idea is still available, because, as I recently mentioned, only a confirmed second consecutive close below the interesting 61.8% Fibonacci level of the whole of the 2016 action at 136.54, which looks like an ad hoc neckline, would help this idea a lot, and we've only so far had the one close below. Finally, as a counter to all this bearishness, I would remind you all about my words from earlier this week on how this was the first challenge to the long moving average since September 2020. And to please note, that challenge back in September last year was unsuccessful. So far today, initial reactionary move back down and away from the overhead declining short moving average, and it's dropped down as far now as the long moving average. There's a possibility, is still faint, that we may have the long moving average become a sort of attractor for the market, and we may even have perhaps a bearish dark cloud cover. We go much further, a bearish engulfing pattern, but it's getting interesting, but it's still a little bit early to see what's going to happen. Euro sterling, second bearish black crow yesterday, and a suitable follow-on lower to the previous session's bearish engulfing pattern. This time the market punched down through and closed below the medium moving average, currently at 86.01, the short medium moving average currently 85.87, and back down through the top of the May to date based bear channel, broken bear channel I suppose, currently between 84.81 and 85.69. Now the origin of this move low was the market's negative reaction to the overhead resistance of the April 2020 low at 86.69 earlier this week. Meanwhile, below the lower bear channel line we have the support at 84.69. This support had originally halted the decline back in April. Now, with a week to go until the end of July, we are already set for a possible monthly key reversal. If we close on Friday next week either over 86 even or under 85.70, then we'll be on. Anything in between would have a lesser outside month. As I closed the business last night, we were looking at a monthly key reversal down, which had rapidly changed from the previous session's close when we looked at a monthly key reversal up of all things. Now so far today, an interesting pullback up over the bear channel line, but then we're halting just under the short medium moving average, and we've pulled back down now to just underneath the bear channel line again. So it seems to be some sort of build up playing between the bear channel line, the upper bear channel line, and the short medium moving average at the moment. US dollar against the Indian rupee. After a really interesting two-day pattern over Tuesday and Wednesday of a bearish inverted hammer pattern, yesterday had a move lower, if limited. It was a lower indecisive doji cross. What was interesting was how it opened and closed below the lower trend line of the recent mid-June to date ascending broadening wedge pattern. Now this is still a little early, but it might be a warning sign that we may be about to break out of this wedge pattern. So just in case, if you have a confirmed breakout below, then the move will be about half a rupee below the break of the lower trend line when it happens, or in this case it was, if it is genuine, the initial move down will be into the 74 even area. I've not marked it as a target, not yet anyway. On the way down it would have to negotiate the 50% Fibonacci line of the February to April 2020 move at 74.26, as well as some late June congestion between 74.10 and 74.20. However, and it is a big however, wedge patterns are very prone to false breaks, and this may be one of them. Additionally, they have pullback issues in that they may drop down, as we've seen here, pull back up then quite a bit, giving the impression of a false break, and then drop down for real at a later time. Hence, great caution in how you react, as all may not be as it seems at first glance. Now, so far today, well, a strange day. A move higher, but then the market's fallen back, down again, back below the lower bull channel line once again. And we're looking like a second indecisive pattern in a row, this time a spinning top perhaps. And also maybe with aspirations to possibly be a bearish engulfing pattern. We'll see. US dollar against the Brazilian real. A strange reactionary pattern yesterday. It looks like an indecisive spinning top at first glance. However, if you look closer, you can see that it is also a reactionary bullish harami as well. The market opened higher, tried to rise, but then was capped by the breach, but still potent, descending upper time, currently at 521.03, of the late May to early July bearish Andrews pitchfork. I've wondered this week if this pitchfork would last actually the whole week. But anyway, the upper time capped the market. Meanwhile, below we still have the flatlining short medium moving average, currently at 514.11. Let me get it right, 514.11. And the rising short moving average, currently at 515.55. Now normally I would not mention the short moving average, but it played an invaluable role in halting and turning the market back up last week, so it's worth a mention. Overall, we still have the argument I outlined last week, that is for the late June to date action being a bull flag, but for me it is still too early as yet. You see, you could as easily argue the July action is a double top, so all it needs is time. This all is in the shadow of the remarkable number of dead crosses we've seen here since late May. So it all now depends on whether the bearish Andrews pitchfork will reassert its hold Beyond, on the top side, we have the declining medium moving average currently at 533.05 and the long moving average currently 535.59, both now actually entering the frame of the market. US dollar against the Mexican peso. A second, if lower, indecisive spinning top yesterday. You could argue that it was a second bearish black crow as well, but that would be a stretch for me. As I mentioned yesterday, prices have recently become enmeshed within the declining overhead resistances of the medium moving average, currently 2011.20, and the long moving average, currently 2018.30, closing once again just under both and lower on the day. Now this brings back up the extensive indecision we've seen previously in the market, indecision that actually stretches from the fall back to the levels originally seen in mid-April, but which recently started again in late June. So overall, the adherence of the market to the gently declining neckline of the February to March head and shoulders top, currently at 1986.80, is still indicative of this neckline acting as an attractor for the market. Further below, we have the April to May based congestion zone between 1985 and 1995, with the neckline lower still, currently at 1960.40 of the late January to mid-May head and shoulders top, acting as further support. So far today, higher open on the declining medium moving average, but an immediate move lower, though one could hardly call it a move as it is fairly small right now. Does look like two declining moving averages are actually exerting a continuing bearish impact overall on this market. Thank you for listening. This short version broadcast gives essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.